Okay.
We can start.
Good evening, ladies and gentlemen, and the erudite speaker for the day, Ganesh Prabhu, Balakumar sir. Today, from 5:30 to 7:30, we have a webinar on the in-depth analysis of GST annual returns and reconciliation statements. It's a 2-hour session, and as you all know, it is a season of the annual returns of GST after completion of the season of the tax audits and the filing of ITRs. So it is a very important topic for now, and I thank the chairman, Chinnamastan Talakaila, for having given me the opportunity to be the host for this day's seminar. And before we take off, I wish to introduce the speaker formally, even though most of you know the speaker. It is customary and the decency demands that I shall introduce the erudite speaker for the day, Ganesh Prabhu sir. He is a graduate in BCom from Madras University and has done his master's in financial management from Pandya University and chartered accountant from the ICAI, Bachelor of Law from Karnataka State Law University, IS audit from ICAI, certification course on direct taxes from ICAI. Is a partner of a firm C. Ramasamy and B. Srinivasan, and as a partner specializing in indirect taxes for more than a decade and heading the GST and indirect taxation compliance, advisory, and litigation vertical practice. And he is a resource person in ICT Academy and a visiting faculty in various institutions, including ICAI, ICSI, and handled classes for professional students and member of the governing council, and was the immediate vice president of the International Chamber of Commerce, Chamber of Indirect Tax Professionals. He regularly writes articles in reputed financial dailies and magazines and participated in various shows and debates in television. Won first prize in the All India 5th quiz competition for CA students conducted by ICAI. He has various achievements to his credit, which I don't want to take a lot of time because you all know about the capabilities and the achievements of the speaker for the day. So with this, I very warm welcome all of you, all the members as well as the speaker, and request the speaker to take over the proceedings for the day. Over to you, sir.
Thank you, sir. A very warm welcome to all the members, senior and learned members present here. It is always a proud privilege moment to be part of various initiatives of SIRC. Having understood the season, and it is a time to refer thoughts and memories in connection with the annual compliances which is ahead of us on 31st December. The SIRC has very rightly has organized and also allowed us to make a presentation in connection with all this. When this topic is handled to me in connection with a little more detail on 9 and 9C, are there any updates? Because when we get into this aspects of 9 and 9C, there were certain changes overall in every year. Certain tables were made optional, certain tables were made mandatory, and there was change between the financial year 17-18. Few tables were optional, and 18-19, the same set tables were optional. Then in 19-20, there was a change. Similarly, what are those prominent changes that are there and the methodology that need to be opted by us in terms of reporting in the form GSTR 9C, 9 and 9C is being will be discussed during the next 120 minutes or so. Before we begin with the presentation, I'm sure all of us are already aware in connection with the requirements of the compliance under GST. Any organization whose annual turnover is going to exceed 5 crores, then no doubt they have to file the annual return and the reconciliation statement. In case if an organization turnover is going to be less than 5 crores, but it is more than 2 crores, then for them filing of annual return becomes mandatory. And if an organization whose turnover is less than 2 crores, then the said organization is given an option and it is exempted. It is given an option that it is exempted from filing form GSTR 9. So in this model, the deciding criteria numbers are going to be aggregate turnover. The term aggregate turnover is defined under CGST Act. Section 2, subsection 6 would come out and define the term aggregate turnover. Let me make a small caution here, because many times we scan through the organization financials, profit and loss account, and start deciding the applicability of the organization. Do agree with predominant of our members. Yes, there is an importance that need to be given behind the the annual turnover, or in other words, the aggregate turnover, the definition that is defined over the form in CGST Act for applicability of form GSTR 9 and 9. What is the interesting aspect here? There is an organization with 2 branches. In Andhra Pradesh, the organization makes a turnover of 120 lakhs. The same said organization has a branch in Karnataka, and there they do a turnover of 60 lakhs. No doubt about it. Annually, the financial statement reports a turnover of 180 lakhs. But an interesting fact to note over here is during the period, that is during the financial year 21-22, there are goods moved from the Andhra Pradesh branch to Karnataka branch, otherwise very popularly called as stock transfer. In the language of GST law, it is a supply, deemed to be a supply, and this turnover would have been captured as part of Andhra Pradesh outward supply. Naturally, the Karnataka organization claimed input tax credit. But when it comes to the financial, the branch transfer and the stock receipt get knocked off, and it will not form part of it, as all of us already aware. For the purpose of computing GSTR 9 and GSTR 9C, no doubt 120 lakhs of the turnover of Andhra Pradesh plus the Karnataka turnover of 60 lakhs plus the stock transfer value of 40 lakhs. If I add it up, it reaches or surpasses the number of 200 lakhs. A small calculation need to be done at the start of beginning of the set assignment, whether at all it is required or not. Let me repeat it. There are cases where it breaches in a very small way. Almost the turnover is 4.8 crores, and there is a missed out interest income, a missed out turnover, a missed out non-GST supply, or certain other exempted supplies which are all omitted to be reported. When we sum it up all that, it crosses 5 crores, then the trigger for filing reconciliation statement would apply. So before even getting into a detailed analysis of GSTR 9 and 9C, let me caution at the initial level, the applicability is based on aggregate turnover under section 2, subsection 6 of the CGST Act. Having said that, that is how the turnover is going to be determined, and then we are fixed that yes, to this particular assessee, GSTR 9 annual return is applicable. To this particular assessee, GSTR 9 annual return plus the reconciliation statement along with 9C need to be filed. When we have crystallized, then all that we need to go ahead is proceed with filing of GSTR 9 and C. I'm sure all of us are by this time little conversant in connection with the number of parts that form GSTR 9 as it has about 6 different parts. Where the part 1 takes care of the basic information such as the GST number, financial year, the legal name, the trade name, and the period for which it is going to be filed, and the due date for which it is going to be filed. Those information followed by Part 2 handles completely about information in connection with outward supply. Part 3 completely about input tax credit, followed by part 4 of the from GSTR 9 discuss about the tax paid, or in case any omitted turnover, erroneously reported turnover, or changes in rate of tax, or on account of reversals of ITC or wrong claim of ITC, the taxes already paid and the tax payable now to be combined in combination need to be reported in part 4. The most and the crucial part would be part 5 in terms of the current year. In other words, for the financial year 2021, for the financial year 21-22, those transactions that are subsequently reported when those information are captured as part of part 5, followed by part 6 is all in combination about the refunds, the demands, the HSN related summary, and few other information associated with it. So each part by part, table by table, we will take it up. Before we step into any further discussion on this topic, the login screen is going to be like this. I thought it would be proper for me to discuss in the same fashion in which the return screen is going to be seen by us over there. When we log in to proceed with filing of form GSTR 9, then before we prepare filing it, there would be 3 system computed documents will be available, very popularly called as SCS, System Computed Summary. A system computed summary of form GSTR 9, a GSTR 1 summary of consolidating all the 12 returns filed by a registered person for the financial year 21-22, and a GSTR 3B summary which will be consolidated and presented for the financial year 21-22, which will be consolidated and present over here, will be made available. Something very important and interesting to note over here is this. These statements, no doubt, are auto drafted statement or auto computed statement based on the GSTR 1 and 3B filed by the respective taxpayer. The respective taxpayer periodical returns are filed. I'm sure all of us on this count will agree to me that unless and otherwise April 21 to March 22 GSTR 1 and GSTR 3B is not filed by a registered person, the annual returns will not be activated. So they have a software control over here, which is also very right and proper. And this summary is an extraction of that data. Why it is required? To know the annual numbers of certain transactions, it would be of great help. And in case of any variance between the books of accounts and what is reported, we may be able to plot down the reason for differences in connection with it. In our next 2-3 slides, we will be able to we will be completely discussing the models or the method in which the form GSTR 9 need to be reported. At that time, we would be able to establish and appreciate the fact associated or the importance associated with this summary of all these summaries of GSTR 1, 3B, and 9. And this is the only document that is available, which is a summation of all 12 returns. The table number 4 to table number 9 will be positioned in the first layout, various tables belonging to different parts, and starting from table number 10 to table number 18 will be positioned in the next set of the layout, and then followed by a late fee option would be the layout in which form GSTR 9 would be located. Before we discuss further in connection with part 2, outward supply, or details in connection with outward supply, upfront disclosure related discussion. I'm sure everybody virtually present over here will agree to me on account that during the financial year 21-22, when form GSTR 1 is filed, there would be a high possibility, for many of the assessees, transactions relating to financial year 2021 would have been reported in the financial year 21-22. How it is possible? As simple as that. March 21 omitted transaction may be identified during a statutory audit and would have been reported in August 22 return. So in other words, I cannot simply add my 12 returns and report a number, because it is the previous year transaction is got reported in my GSTR1. All that I want to drive home here is, this is where the summary data will help to make all our calculations little easy. Let's, for an assumption, assume every month there is going to be a tax invoice for a value of rupees 1 lakh. Then the turnover is going to be 12 lakhs. But in August 2022 alone, it will be 2 lakhs reported. Why? Because it is March 2021 omitted invoice got reported during the financial year 21-22. In other words, that if the previous year turnover is got reported in subsequent year, do I need to add the turnover and report it in 9? The answer to that is on the heading of the table, where the table 4, which discuss about the outward supply, is very clear that all those advances, inward supplies made during the financial year. For our better convenience, I have blocked it in the red color and emphasized that transactions effected during the financial year. So in other words, if it is a previous year turnover got reported in my GSTR1 of this particular financial year, for which I am going to proceed with annual return, that turnover will not form part of my table number 4. Upfront understanding. Similarly, this year turnover got reported in subsequent financial year. Again, that will also not form part of my table number 4 of GSTR9. To some extent, this discussion with the table number gains it important, because it is only a disclosure requirement, and this disclosure requirement is a mandatory disclosure requirement which need to be complied by the respective taxpayer. Now, in which form GSTR3B I have reported my turnover? In, let's say for a moment, this year also there is an invoice that got missed and it got reported in subsequent financial year, August 2022. Then it should form part of table 10 of GSTR9. It cannot form part of table 4 of this GSTR9. In nutshell, that year transaction alone will get reported in table 4. That too, that year transaction properly reported in GSTR1 will alone form part of table 4. That financial year transaction got omitted to be reported and then got subsequently reported in subsequent financial year, GSTR1 will form part of table number 10. Similarly, that financial year transaction neither reported in that year GSTR1 nor reported in subsequent financial year, which means technically it got omitted to be considered, but assessee is assessee has accepted, agreed, and assessee is ready to pay the taxes. In other words, it is not at all reported. That would be added back to table number 4. So invoices reported during the financial year plus invoices completely omitted or ignored during the financial year will form part of table number 4. Invoices issued during the financial year but got reported in the GSTR1 of subsequent financial year will go to table number 10. Important modality which need to be processed, accepted and reported only in this format, because when you go to the respective table 10, 11, 12 and 13, we would come to know this is a mandatory reporting which need to be done by the registered person. So during the period, let me repeat, during the period if it's a small SSE, only that year transactions they have reported. There is no question of previous year transaction got reported in this year. Then there would not be any challenge at all. Entire data would get reported in table number 4. So that financial year transactions. In other words, for a easy reference, all those transactions reported in Form GSTR1 for the period from April 21 to March 22 would be reported in table number 4 under 5 different buckets. What are the 5 different buckets of reporting, or what are the major category of reporting? The major category of reporting is going to be B2C transactions, business to consumer transaction, B2B transactions, followed by export of goods to SEZ with payment of tax, export of goods to foreign country with payment of tax, supplies to SEZ with payment of tax, and deemed export. Just 5 identified transactions, a summation of all this turnover along with the tax payable, inter, along with the tax payable need to be compiled. Usually the system computed summary, which is pre-filled form number already reflecting over here, is based on the GSTR1 filed by the registered person. From the GSTR1 filed by the registered person, we would be able to see automatically the data will get pre-filled and available in the form GSTR9, which can be used as a reference. Let me repeat, it can be used as a reference, but it cannot be relied upon completely. Now, coming back here, broader 5 buckets, as we discussed, is going to be only B2C transactions, B2B transactions, exports to foreign country with payment of tax, supplies to SEZ with the payment of tax, and deemed export. Now, that would be the first level of reporting, and these reported numbers means it can be only 2 things. One, either those invoices are reported during the GSTR1 from April 21 to March 22, or a few invoices which got omitted to be considered at the time of invoice. For some reason, then it can be added. No. A previous year invoice. Let me repeat. A previous year invoice I reported during current year. Good. That will not form part of table number 4. Previous year invoices reported in current year GSTR1. Is it possible? Yes, very much possible. That will not form part of table number 4. Instantly, some of you, it can click to you that no, if I do that, I will have a difference in table number 9. You should table number 9 of GSTR9, the tax payable table. Definitely you should have a difference. Only then it will match with the previous year table. When we go back to previous year for a moment, pausing all the discussions here, in the form GSTR9 of 2021, we would have went to table number 10 and said so much turnover for which taxes I have paid in the subsequent financial year before September. This is a point that I want to refer. So once a turnover is already added in the erstwhile return, it cannot be once again added over here. A careful reporting need to be done in connection with table number 4. Once we have done with the basic classification associated with all this, quickly all that we need to do is aspects in connection with advances. Very rare. Advances received for which tax invoices not issued. In case if that number is available, first of all, it should be a service provider, and that service provider should have a practice of receiving advances, and on the advances they should be discharging the GST liability, and If the advance received and the invoice issued is in the same year, then the whole aspect is over. Unadjusted advances, advances for which tax invoice is not issued. If in case any money is there, that would be reported as part of table number 4F. A little careful reporting need to be done when it comes to advances, keeping in mind the reconciliation of opening unadjusted advances and closing unadjusted advances. So opening balance, closing balance, and the effect associated with it should be given over here in table 4F. Details of inward supply on which tax is payable under RCM. In other words, in very simple term, the RCM liability of the respective taxpayer for which the taxes under RCM discharged in form GSTR 3B will be reported in 4G. 4G is a summation of all the invoices under reverse charge. The supplier has discharged the tax liability. Under RCM, they would have discharged what is the value, and in case if for an RCM, if they have not paid, and they are prepared to pay for now, if they are prepared to pay for now, then there are two options of reporting. Both the options are available before an assessee. Option 1, they can include the turnover in the 4G. Taxes will be added as part of table number 10 and discharged through table number 14. Option 1. A little tricky option. Unless somebody have a better control on the reporting of numbers, it would be there. Or else simply discharge to DRC 03 and make a comment that so much tax is discharged under RCM, and if it is well within the time limit and they have taken credit, then they would have been taken credit, or it is a cost to the company. Based on that, it can be done. But RCM not disclosed or unreported, or RCM is there, they have not complied with, which they want to comply now, and it is all well within the time for taking credit. If that be the case, then yes, 4G would be the place where they report. Government earlier came up with the option that in case of all those transactions of either B2B supplies or exports to foreign country, supplies to SEZ or deemed export, in case of all those transactions, government has given an option. You can report net of all those amendments, debit notes and credit notes. That option was there. For the financial year 21-22, for the first time, they are withdrawing this option, which means the takeaway is like this. If I have a gross turnover of 10 lakhs and during the period there is a sales return on account of return of goods of 1 lakh, my net turnover is going to be 9 lakhs. All along from 17-18 to 2021, we used to report straight away B2B supplies 9 lakh. Henceforth, it will be 10 lakhs gross turnover plus credit notes 1 lakh, a mandatory reporting, which is something new, will be applicable effective from 2021-22 onwards. Similarly, in the case of any amendments on account of increasing the rate of tax or decreasing the rate of tax, or increasing the value of supply or decreasing the value of supply, where 10,000 rupees is erroneously feeded as 1,000, or 1 lakh rupees is erroneously feeded as 10 lakh rupees, which warrant a downward reduction in the value of supply or an upward addition in the value of supply, where all other details remain same, where this is possible through an amendment under GSTR 1 table number 9. Those information need to be reported independently. Earlier, it will be net number will be reported in 5 buckets. Henceforth, it is going to be gross number will be reported and the net number will be arrived in table number 4N, where they understand after all these adjustments, finally it will be the option to file net of debit note, credit note stands withdrawn by this for this financial year 21-22. Moving towards table 5, where table 4 concentrated more on outward supplies, which is liable to tax. Table 5 concentrates more on outward supplies, which are exempted from tax, or I would put it in a little different way, supplies on which tax is not payable. So all those supplies on which tax is not payable is going to be the part of table 5. Here also, we would be having broadly 5 buckets of information, and over here, zero rated supply without payment of tax, which will have 2 corners, which means export of goods or services without payment of tax under LUT for the compliances, followed by supplies to ACZ without payment of tax, those related information. Then a very important entry, which is supplies on which tax to be paid by the recipient on reverse charge basis. Some of the organization fail to appreciate the importance of table 5 subclause C. Table 5 entry C particularly discuss about organizations who are in forward charge, but 1 or 2 activities of them would be covered under reverse charge. Let's take up a live situation of 2-3 units. Let's take for a minute. It is going to be a 2-wheeler or a 4-wheeler authorized service center who also sell 2-wheeler, 4-wheeler, and also indulge in the activity of repair, maintenance, and all. Now, in case of all these 2-wheeler or 4-wheeler organization, for the purposes of insurance, they get a small insurance commission. That insurance commission under reverse charge, the respective insurance company is paying under RCM. But however, the commission is received by them. Technically, that will be covered over here. Take in case of CHA, the Customs House Agent Services. There is a likely possibility that one of their services could be a GTA services, and they would have very promptly opted that for GTA services, under a forward charge, we will not pay tax. We are asking a recipient to pay tax under reverse charge. In fact, they would have issued a GTA invoice independently prescribing reverse charge, yes, and asking the other party to pay tax. Those turnover where actually he is a supplier who is covered under forward charge, that supplier in case has or provides an outward supply which is liable to reverse charge, need to be reported under table 5 entry C, a very careful entry, because this also warrants a reversal of common credit as per section 17(2) read along with rule 42, 43 as the case may be. So coming back here, this is an entry. One of the very latest examples of this is all along. It used to be a 3-bedroom hall kitchen apartment in a flat. This flat is rented out to a professional. So the owner of the flat is already into various rental receipts, commercial, all that and all, commercial receipts, consultancy receipts, all that. As the owner's turnover crossed more than 20 lakhs, the owner took registered, promptly collected under forward charge. A day came, government announced from July 2022 onwards, it is going to be the case of RCM applicable on residential properties which are rented out to a registered person in spite of the landowner or the property owner being a registered person. Which means for my commercial properties under forward charge, I will pay tax. For all my residential properties which are rented out to a registered person, which is again in turn used for a business purpose, he being a registered person under RCM, he will pay tax. Then I'll issue invoices under RCM applicable to him. And that turnover will get reported over here. Even still, some of us are not convinced. A classic example often I would say over here is all those services provided by advocate. And they are registered because they have an ancestor property which is on the heart of the city, and that property is rented to a bank, and the bank pays a simple rent of 3 lakh rupees per month, which crosses 36 lakhs, for which registration required, which will be form part of table number 4, no doubt about it, outward supply. The advocate services provided by the advocate to a recipient or a business unit, then the respective business entity is liable to pay tax under reverse charge. That turnover will get reported in 4C. That is all about the entry. Moving forward, exempted turnover, nil rated turnover, non-GST supply. Let me emphasize over here, all along the government accepted that among the 3 entry, if you club and put everything under exempted entry, in case if independent details are not available with you, we'll accept that that option is withdrawn. For financial year 21-22, the exempted goods or exempted services turnover need to be reported under exempted category 5D. For the financial year 21-22, if the activity is a non-taxable supply, which is not a supply covered under GST. A classic example could be petroleum product, tobacco products, not tobacco products, liquor. Then it would form part of the non-GST supply, and a few goods alone and few services alone covered under nil rated supply. So that independent classification is required and need to be reported. More importantly, if a supplier is engaged in non-taxable supply, a supply which is neither leviable to, nor it is neither a goods nor a service not leviable to GST, it is not covered by GST law, then that turnover need to be mandatorily reported independently, which is a requirement of 21-22, which was not a requirement all along under the erstwhile annual return. Often doubts used to come over here. If in case somebody has omitted to report an exempted turnover, what would happen? Nothing would happen. It has to be reported now. That's all. An exempted turnover omitted to be considered during the respective form GSTR 3B may be considered at the time of filing an annual return when the annual return is going to be filed as per table 5. Quickly getting into the debit notes and credit notes followed by amendments in connection with the exempted turnover. Government is still holding the option when it comes to exempted supplies. The debit note, credit note amendments can be adjusted and net numbers can be reported for either exempted turnover, nil rated turnover, or non-GST turnover. Somebody has sold some goods which are exempted in nature. Later, those goods, a few goods got returned. They may net it off and report as 90,000. Unlike the taxable supply where gross and credit note need to be mandatorily reported separately. That separate requirement is not applicable for exempted turnover. Quickly getting into part 3 of GSTR 9. When it comes to part 3 of GSTR 9, in fact, part 3 of GSTR 9 in-houses 3 tables in GSTR 9. Table number 6, table number 7, table number 8. Table number 6 primarily discuss about the ITC taken during the financial year. Let me supply emphasis to all the words that I have uttered, because To my understanding, these words gains the moment. ITC availed during the financial year. Now, what do we mean by ITC availed during the financial year? At no stretch of imagination, beyond 12 months from GSTR 3B, what was the number? The ITC cannot exceed that. ITC cannot exceed the amount that is being taken already in GSTR 3B. Then what are we going to do in table number 6? Table number 6, we are going to now report among the ITC taken in GSTR 3B, how much is inputs, how much is capital goods, how much is input services. Under RCM, how much is inputs, how much is capital goods, how much is input services from unregistered person and registered person. When it comes to import of goods, how much is from capital goods, how much is IGST import, how much is from capital goods, how much is from inputs. That breakup for the first time assessee is reporting in table number 6. In other words, the number that we could able to see on the screen, 94,85,828. I need to give the breakup for the IGST. How much is on account of B2B supplies? Let's say 40 lakhs is B2B supply. Among that 40 lakhs, how much is input? How much is capital goods? How much is input services? Let me make a small caution here. All along, government used to accept if you have the detail, independent detail of input, capital goods, and input services, report accordingly. If in case you come out and say, I don't have that detail, which is to confirm that it is input, capital goods, or input services, you put all the credit that you have taken on B2B supply under the broader heading called as inputs, we accept. That facility or that option is withdrawn for financial year 21. Which means transaction level breakup category of ITC gains its importance. And I'm sure majority of the organization in their input tax credit register or a register maintained under section 35 of the GST Act started to capture this information that on the transaction that they are taking credit, is it an input services or capital goods, which would be the basis for claiming credit. What would be little challenging to predominant of the organization is, no doubt, majority of the organization comply with RCM. But during their compliance, am I paying reverse charge for a registered person, or am I paying reverse charge for an unregistered person, is often a data preferably not maintained by the SME segment. For a moment, I'm ignoring all those large enterprise, which is their accounting enterprise models provide that information. But from a SME perspective, majority of the organization, I pay for my vendor. I understand, and I am not very sure whether that vendor is registered or not. In that circumstance, if they have paid RCM, but that information is not available, whether that person is unregistered person for whom I paid RCM or registered person to whom I paid RCM, the old option given by the government is still intact, that if you are not sure whether the other party, that is your recipient, is registered or unregistered, report the number under the registered category. In other words, if I'm not very sure whether the data would come under 6D, table 6D or 6C, then my default option would be 6D would be the default option where the breakup of my RCM will be reported. No, I'm very sure the advocate is registered, then it will come 60. No, I know very sure there are 10 transporters, 6 of them are unregistered. Then that money will go to 6C, and the balance 4 operators money would come to 6D under input service. It's only a reporting requirement to ensure the importance of the compliance is all made in a self-assessment regime, where section 59 comes out and gives that everything is going to be done based on written, and we have some of the scrutinies that are picked up based on section 61, only out and out analyzing the GSTR 9 and 9C filed by the registered person. No doubt filing of 9 and 9C gains is important associated with it. Quickly getting on to some of the other aspects of input tax credit. In case of import of goods, the breakup of input and capital goods need to be given. In case of import of services under RCM, if they paid, then those information need to be reported separately. If the organization claim ITC from input service distributor, then those amount to be reported separately. At times, organization would have reversed input tax credit because they have not made payment to the supplier within the time limit prescribed under section 16(2), which is 180 days, proviso to section 16(2). In connection with that, if they would have reversed the ITC and after payment, if they have reclaimed the ITC, then that turnover need to be reported as part of, that ITC should be reported as part of 6H. So that would be predominant of cases, or in case an assessee who has reclaimed his rejected refund rejected recredit, then it would also form part of 6H. But recredit of refund is little rare. Initially during 17-18 we had for many assessees, but over a period of time the refund portfolio or the refund module got stabilized. I'm not saying today we don't have, but its usage is getting reduced to the core possible. Now when we draw a number after all this, B2B B2B supplies, inward supply B2B, inward supply RCM of unregistered person, inward supply RCM of registered person, import of goods related services, import of service related services, IS, and all those credit earlier reversed for non-payment within 180 days, which has been reclaimed. If I sum up all these numbers, it should match with the credit that is taken by me. In case of any differences, which means we have to analyze. What is the reason for a difference? The reason for differences might be as simple as that. Previous year ITC, input tax credit, would have been availed during this year. We may fix it. In spite of after all these adjustments, we still have differences. Then it may be leading to excess claim of ITC, where to that extent information is not available. However, ITC is being claimed. That difference need to be brought out under 6J, and the same need to be discharged by the assessee by way of a form DRC 03. Special credits like transactional credit. Today we will not have much of transactional credit. Maybe after the conclusion of 22-23, we may have a few transactional credits might be claimed by some assessee, or some special circumstances ITC, like somebody move from composition levy to normal levy, or somebody on account of merger acquisition, they claim or they get entitled for a ITC. Those special circumstance ITC would be reported as part of table 6M. So the very purpose of special circumstance ITC is going to be all those on account of M&A, or on account of business transfer, on account of slum sale, or on account of conversion from the erstwhile. Earlier the product was exempted, now the product became taxable. Earlier he was under composition levy, now where section 18 is got invoked. These are the situations one can expect in connection with a special circumstance ITC, where we have a special form for all this ITC 02, which need to be filed for transfer of credits, or ITC 03, which need to be filed, or ITC 01, which need to be filed in connection with all this. quickly getting into a summation of all this. Once we sum up, we will have the credit. That is the input tax credit availed by the registered person during the financial year. A summation number we will have over here. That is the ITC that has been taken by the registered person during the financial year. Having said about ITC taken during the financial year, stepping into the next element is ITC reversed and ineligible ITC for the financial year. Again, let me get into the headings and let me get into the terminologies associated here. ITC availed during the financial year. Here, ITC reversed for the financial year. So, for the financial year, I reversed in the respective return also will get disclosed. For the financial year, if I reverse in the subsequent financial year, return also will get disclosed. That is the subtlest point that need to be appreciated here. For that year, whatever ITC I reverse, either to DRC03 or through 3B, subsequent year financial year 3B or that year 3B will form part of table number 7. That will be the differences associated with it. What could be the reason for reversal? All known reversal for us. If in case the distributor who distribute ITC also distributes a credit note because it is an ineligible credit, also distributes an ineligible credit which need to be reversed because he can only distribute. He will distribute all the credit, eligible credit, ineligible credit. So if as a ISD recipient, I need to reverse. I need to pay my suppliers within 180 days. If I fail to pay, I will reverse. That will be reported as part of the Rule 37 reversal. On account of engaged in business of both taxable supply and exempted supply, taken case of a departmental store, a grocery store, or somebody is engaged in both taxable and exempted supply businesses, or somebody is dealing in a pharma products where few pharma products are exempted, few products are taxable, or somebody is going to be a dealer to a multinational company or a stockist to a multinational company where the multinational company is into the retail trade and they are having both sort of goods, or somebody whose mainstream business is where one product is exempted, other product is taxable, or it is same product when I supply to a particular organization, when I'm going to supply to some of the government related entities or to government, if I supply it is going to be exempted, and the same product if I sell it to outside of market it is taxable. Reasons could be NN number including bank, where a portion of revenue is exempted and a portion of revenue is taxable. In those circumstances, as per section 17(2) read along with rule 42 and 43, ITC need to be reversed. The ITC which is reversed on account of rule 42 for input and input services to be disclosed in 42, for capital goods to be disclosed in 43. A specific requirement, let me repeat from that day one, government used to press upon, if you have the data for it, please report in the respective rows. And it is always better to report it. Larger the organization, be it, forget, to my mind, if the turnover of an organization crosses 5 crore, then a reasonable amount of compliance the respective organization has to ensure. In those circumstances, that 242, 43 and all is involved. Reporting at least at the annual return has to be little more proper. No doubt, the instructions below to table, instructions to GST R9 is little liberal only. No doubt. What restrictions that we had in table number 4, what restrictions we had in table number 6, such restrictions are little relaxed over here. As long as you have data, report in the respective reversals. In case if you don't have data in connection with such reports, reversal, decide whether this is a reversal for tran credit, that is transactional credit, or it is a regular reversal on account of 37, 39, 42, 43 or ineligible credit under 17.5. If it is on account of 37, 39, 42, 43, ineligible 17.5, then put it under the others. If it is tran credit reversal, put it under tran credit. That is the only requirement. That is the only requirement of government. However, as it stands today, a better presentation could be reporting in the respective aspects. And also a point to be noted down over here is any ITC reversed for the respective financial year in the subsequent year 3D, or any ITC later on discovered, later on reversed on account of form DRC 03 shall also form part of table number 7. Quickly getting into the table 8. Table 8 is little more serious. I'm sure a lot of you will agree with me. We will often say there are only 3 parts in a table is in GST R9 is important. Row 6A is important. Row 8A is important. And table 9, the tax paid through cash and ITC is important. Why we say important? Because on the presentation that is appearing before you, you could able to see a small gray shade and pre-filled number. That gray shade and pre-filled number, preferably that gray shade, is uneditable. In other words, the data will come and sit automatically. From where? From the consolidated GSTR 2A. GSTR 2A of financial year 21-22. So financial year GSTR 2A of 21-22 is automatically summarized and reported as a number. Generally, as time passes over a period of time, preferably last 2-3 years, we get less differences. In the initial 1 or 2 years, we had a lot of differences, but it's getting settled over a period of time. Now, a few challenges are here. What is the date of cutoff for this 8A row is still a magical news. I'm not joking, I'm very serious on this ground, because of a reason that the cutoff for filing and taking credit for me per se has not stopped. But however, there are 2 different views about it. No, if the data has to be reported in your 2B, only then you can claim. I do agree, that's a separate dispute. Prima facie, I don't buy the point until, or at least up to 31st December 2021. I am of a view matching has its own challenges associated with it legally. That's a separate point which need to be debated little later. But the point that we want to drive home over here is ITC taken during the financial year and the 2A reported. If 2A is more, ITC claimed is less, then the organization is not into much challenge. ITC reported is 86,32,765, whereas ITC claimed by the organization, both considering current year reported and this year ITC claimed in subsequent year, all put together 86,25,532, then I am on a little favorable stand. I don't need to much bother about it. But the challenge here is this 2A data is after adjustment of credit note. After adjustment of credit note, the data comes. Please, somewhere mark it over here. Table 8A is a net ITC and table 8B is a gross ITC. You are bound to have differences. When somebody analyze it very carefully, you will definitely have differences. That too, if you have a supplier from whom you have procured the goods, and you have returned the goods in the previous year, and that beautiful soul has reported his credit note in the subsequent year, times ahead will be interesting in terms of reconciling this. Let me press a point here. 8A is net ITC. In our majority of the working, it comes and gets reported only in that way. Whereas in the 6B, what we report, predominantly we report gross ITC. Or the credit note is not relating to this year. The credit note is relating to an earlier year, which when everything has got moved to 2B is the most important point. 2B is all, only with 2B everything you are going to do. It is not fair on the part of the portal to change this also to 2B. Now, there will be inconsistency in the data. That inconsistency in the data need to be analyzed, and at least a report need to be made available at the organization level to understand the differences. Reason for difference should be a tool, at least at a macro level, not at a minuscule level of transaction level differences. In my view, that is also required, but that can be always worked on at any point in time. But macro level differences, reasons should be made available. As simple as that to me, I foresee something like this. This year data is 4 lakhs. This year data ITC is 4 lakhs. But in my GSTR 3B, I took 6 lakhs credit. Naturally, I'll have a difference of 2 lakhs, but somebody has to appreciate it. In my last year turnover, in my last year annual return itself, I have reported my last year, that is 2021 ITC of 2.5 lakhs. I am claiming in subsequent financial year, which means on my 6 lakhs, if you reduce the 2.5 lakhs, my net ITC for the year is 3.5 lakhs, which is less than 4 lakhs, is a justifiable point. No doubt this year ITC will be claimed in the subsequent year. So my only intention is this basic working need to be prepared. Earlier, even if there is huge differences, what is the actual number you may report it was the government stand for the first 2 years. That option is precisely withdrawn for this particular year, stating that no more uploading of data. We would go only by this particular differences. And in my view, a reason for differences need to be made available. When you're going to accept the stand that this year ITC can be claimed in subsequent year, you should also accept another fact that my data of ITC taken in this year, which is my table B, will also have a data of last year. So that row is missing. To that extent, you will have difference. That is a justifiable difference. Same in the case of imports. What is the ITC taken during the period? And in case if it is something is not availed or reversed, what is the quantum of differences that will be analyzed when it comes to import? But by and large, import related ITC are getting reflected in the portal. In case of exceptional differences, that need to be plotted. Part 4 of GSTR 9, which discuss about the table 9, which discuss about the tax payable. In the tax payable, the none of the right hand side rows can be uneditable. If you could able to see here, it will be little white in color. All this will be gray. Gray field represents it's gray. Nothing can be done about it. It's gray. All the white fields can be allowed for editing. In other words, I can report my additional tax payable, if any, for the turnover that are omitted during the financial year, or on account of some taxes that I have to pay, I can add it. There is a tax which is, there is an excess claim, I may add it over here. All that can be possible, but none of my already adjusted amount will not get reflected. If the tax payable amount exceeds the tax already paid, then the difference shall be paid through form DRC 03 by the respective registered person. Again, there are two views in connection with, if somebody meticulously read the instructions, that the instructions would come out and say the money need to be discharged. Any tax payable under annual return shall be discharged only by cash. However, a lot of experts disagree to the view. I also disagree to the view that it cannot be said that which is not taught at the section level, which is not taught at the rule level, neither section 44 nor rule 80 is silent about its payment. And when payments can be accepted both in cash and credit, something, if it is to do with the reversal of credit, has to be discharged only by reversing an existing credit already with me. No, 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 you took a wrong credit of 4 crores, so you pay 4 crores to me. Where will I go to pay 4 crores? You yourself has accepted it is a wrong credit of 4 crore. I have taken a wrong credit of 4 crores. I have no clue whether I'm entitled to it or not entitled to it. I have a pressing due date. If I miss this bus, I will not be entitled to claim credit. So that is the last day to take credit. So I took credit. And later I realized when I do this when I do this concept of exempted turnover, total turnover, all this is not working out. Let me reverse whatever credit I have taken without any usage. No, no, no. What you reversed is wrong. Pay entire 4 crores by cash. The instruction is very clear. I don't think so. An instruction in the form can be a substantial piece of legislation to instruct an assessee to pay only by cash. To that extent, I differ on that count. But again, coming back here in connection with payments, DRC 03 is open. If it is an ITC related issue, definitely a credit can be used subject to the point for litigation, which is open for there. Part 5 discusses about turnover which was omitted to be considered in previous financial year got reported in subsequent financial year. Very recently, the law got amended by Finance Act 2022 that extending the due date for making all the corrections from the September return filing due date, which usually used to be 20th of October, to a flat date of 30th November. All corrections, all return files up to 30th November, it is allowed. No doubt it's a welcoming move. In connection with it, extending one more month is no joke. From the government side, it has been little liberal in allowing assessee to do all the correction, because any case that other month becomes a due date for filing the annual return. So all corrections can be done and uploaded in the October return of that particular financial year, because naturally the October month return, November will slip the 30th November due date. Same in the case of November 3B will slip the 30th November due date, which means October return would be the most crucial return. Earlier September return, now October return is going to be the most crucial return. Here, a few invoices that got missed, a few credits which got missed. All these are all accumulated and got reported in the subsequent financial year. Then it would be reported in table number 10. Not only invoices omitted, being a credit note omitted or a debit note omitted or any amendments that are made shall form part of table number 10 for invoices and debit notes. Table number 11 for credit notes and reduction in the amendments, where they reduce the value in subsequent financial year. An invoice was erroneously billed in the month of February 2022, where the organization got cognizance of this fact way back sometime during July 2022. And in July 2022 return, the February 2022 invoice was called for in the return for amendment, and the amendment was done. Then it would form part of the table number 11. So these corrections would get reported over here. Same in the case of the previous year ITC got reported in subsequent, taken in subsequent financial year, or the previous year reversals got done in subsequent financial year would form part of table number 12 and table number 13. and this reporting is mandatory. In fact, from 1718, they are pressing this reporting as mandatory, and to this year, it gains a lot more important, as this is the key element. Because if I need to say in my current year turnover in table, now you recollect in your table 4. In current year turnover, so much invoice relates to previous year, means naturally the previous year table number 10 should say so much invoices are reported in next year. There should be a one-to-one link associated with it, which need to be established in table 10, 11, 12, and 13. Taxes paid on 10 and 11 to be reported, and how it can be discharged. It can be discharged to respective return subsequent financial year GST R3B or through DRC03. Different organization have different practices. Certain organization is very clear. I don't want to disturb my GST R3B. Let me pay through DRC03, and any case I'm liable to pay interest, all that and all. Let me keep it outside. There are few organizations pay through DRC03, that is subject to up to the organization. Whatever be it, the paid details, the payable, tax payable details and the paid details to be reported in table number 14. Quickly getting into table number 15 in connection with refund related reporting. All those refund filed by the respective assessee during the financial year. Returns filed during financial year, how much of the refund, how much is sanctioned, how much refund got rejected, and in case of pending refund on the date of filing annual return. In other words, let the refund be for any period. In other words, let the refund be for financial year 1920 filed during 21-22 financial year. Let the refund be for 18-19 filed during 21-22. We are not bothered about for which period refund is filed. We are only bothered about on which date the refund is filed. If the refund is filed during the days of financial year 21-22, when the ARN is generated in the date of 21-22 financial year, then it would get reported over here. So that is the way in which the reporting of table 15 would happen. Similarly, in the cases in connection with any inward supply from composition levy person, and any in case of job work, if the goods have not returned within that 1 year or 3 year, as the case may be, then those information need to be marked, because all this is a special supply. It would be treated as a supply and leviable to GST. A reporting information which was kept all along optional, made mandatory, which is HSN-wise outward supply summary information. No doubt, I am sure all of you will agree with me. This is mandated for GSTR1. There is no difference when it comes to GSTR9. GSTR9, they have ensured the HSN level information. If the assessee's turnover is going to exceed 5 crores, then at a 6-digit level, preferably for all B2B supplies, information need to be reported at taxable value, quantity, rate of tax, IGST, CGST, SGST, how much. Similarly, in case of outward supplies, if the turnover is going to be less than or up to 5 crores, 4-digit level reporting on outward supply is mandated, and it is to be done by the respective registered person for the financial year 21-22. And inward supply information, at least predominant of the 10% and above inward supply information is mandated, but still this option is getting continued year on year from 17-18 till 20-21-22. They have as of now given an option to the assessee. If you don't have that data, we pardon you in non-reporting it. But this is a little contrary stand. This time, maybe the years ahead will make it mandatory that reporting of even for inward supplies would be made very quickly possible. Once all this reporting is done, and when we click on to compute liabilities, we would be taken forward in a small basic preview of GSTR9. Then If in case there is a late fee applicable, then yes, late fee would be calculated. If in case any interest is payable, which can be feeded over here for the purpose of paying and discharging the interest liability associated with it. And once after the final preview of the complete form, they can proceed with filing of form GSTR 9. In case of companies and LLP, DSC becomes mandatory. Others can be done through electronic verification code. Once it is done, we will have the annual return filed, and then we can proceed with filing of DRC 03 simultaneously in case of if tax payable is there as per table 9 of GSTR 9. That sums up the broader discussion in connection with form GSTR 9. Quickly stepping into reconciliation statement. In connection with reconciliation statement form GSTR 9C, we have 5 different parts, or the whole activity is getting converted into 5 different parts, where in part 1, basic informations are captured. Part 2, a reconciliation is done for the audited annual turnover of financial statements with the annual return. That is, we will start with the P&L number and end with the GST annual return number and ensure the reconciliation matches. And part 3 discuss about a rate-wise reconciliation of tax payable vis-a-vis the tax paid as per GSTR 9, and again a gross level comparison of ITC as per books of account and ITC as per GSTR 9. Once all these comparisons are done, if there are any liabilities, would be reported as part of additional liability. Else, there will be nothing much to report. Basic information such as GST number, period, and his legal name or trade name, followed by, if in case he is audited, the nature of the audit that is being done by him, those informations are captured. Table 5. The starting number of table 5 would be, it would start with the audited financial statements of the respective registered person. A point to be noted down here, in case of multi-GSTN assessees, if they have 4-state operation, then it is preferred. 4 different independent financial statements are drawn, and individual respective state financial statements are used for the respective GSTN. It is always ideal to use a independent financial statement for that GSTN in case of multi-GSTN requirement. I would go to a next step requirement of within the state, for best known reasons to the company, within the state, if they have 2 or 3 registrations, in spite of their business is going to be consolidated and there is going to be one financial statement, it is better to have, even within the state, a GSTN wise statement. Let me repeat it. One organization, it could be a proprietary firm. Do agree with a lot of you that one of the business vertical could be something to do with transportation of passenger related services by some vehicle, cars, cabs, all that stuff. Yet another service could be trading in woods, trading and buying and selling of woods. And the third service, third entry could be an outdoor catering service. In fact, this has happened to few assessees. They are into different business vertical. You can ask me why you are pressing on so much on this. For outdoor catering, I'm not entitled for ITC. For transportation of passenger related services, here again, it will be divided into 2 aspects. At times, I would go for reverse charge. At time, I would be under forward charge. If I am under a forward charge, then there is a different aspects. that for certain services, my rate of tax will be 5%. Certain services, my rate of tax will be 12%. Being a service provider, if I provide 5% services, it is treated as an exempted services for the purpose of reversal. Plus, I will be dealing with goods. So all these three businesses are different. It's better to have a 3 independent GST, and that is why they have. It is also better to have 3 independent profit and loss account, balance sheet, 3 independent uploading, 3 independent number for comparison, so that tomorrow everything can be restricted only to that particular aspect. Naturally, let me repeat, the telephone that is used in the trading of woods is not used for the outdoor catering services. But if all are same, tomorrow telephone services will be looked in as a common service. Forget there are going to be common services. I am not bothered about it. But to the extent possible, it can be maintained. So that is one primary reason, even if it is even within a state, GST and wise, it is possible. But of course, it can be easily said than done. So it has its own challenges when it comes to practically implementing it in terms of independent state-wise financial statements. What is the turnover as per the financial statement would be the originating number. In my view, the gross turnover, revenue from operations, other income, a summation of that number, gross number should be fed in over here. Then the adjustment starts. The adjustments can be for if it is a business that has unbilled revenue, there is a concept called as unbilled revenue. There will be an opening unbilled revenue. There will be a closing unbilled revenue. If the organization is open for that sort of billing, preferably contracting firms, preferably some of those event-related firms, or few service sectors will have this concept of unbilled revenue, construction organizing. It is a contract completed but not billed, which means almost all related expenditure is incurred during this in the P&L. So to match that, I need to recognize this revenue as per the accounting standards or the Ind AS as per the requirement. To that extent, I will have. So that unbilled revenue, if it is there, the opening unbilled revenue and the closing unbilled revenue. So unbilled revenue at the beginning of the year will be added. Unbilled revenue at the end of the year will be reduced. Similarly, unadjusted advances at the beginning of the year, at the end of the year will be added. Unadjusted advances at the beginning of the year will be reduced. Deemed supply as per Schedule 1, which means stock transfer, cross charge, whatever be it, that will not form part of a financial statements if it is drawn for the company as a whole. If it is drawn for a GST and as a whole, it will form part of the financial statement. If deemed supply already form parts of the financial statement, no effect need to be done. If deemed supply is not forming part of financial statement, then yes, it has to be done. Followed by adjustments on account of valuation, adjustments on account of forex in case of they have some foreign currency billing associated with it. Naturally, there will be a forex profit, forex loss, as the case may be. That disclosure to be reported separately, followed by a few transactions that are outside the ambit of GST, but profits alone will be reported. In other words, sale of land and building. The organization very early has purchased a immovable property. One fine day, 10-15 years later, organization decided for better prospects to dispose of it. Naturally, there will be a gain on account of the property because 15 years before it was purchased for 1 crore rupees. Now it is sold for 3 crore rupee. 2 crore rupee comes and appears as a in a vanilla profit and loss account, comes and appears as a under the other income on profit on sale of land and building. Now, what would happen to it? It should be added as part of the respective other adjustments, and a breakup for other adjustments to be available as part of a best practice. As I told, an independent data should be available in case of sale of shares, sale of any gains that arise on account of capital, sale of capital goods or sale of share securities, land, all this, because only the profit element will come over here. A technical reporting. Let me repeat, a technical reporting. Now I'm stepping into a technical reporting. If I sold a land for 3 crores, what should happen? In your GSTR9, table number 5, their non-GST supply should include 3 crores. And here in the turnover, in the adjustments, 2 crores, 2 crores profits should be reduced. Sorry, should be 2 crore. Sorry, 1 crore cost of purchase should be added up to match with the annual rate. 2 ways of reporting it. A simplest way, report the profit alone as part of the adjustments, reasons not listed above, 5O, very famously called as. Wherever wherever we don't know anything, then we'll put it in 5O. We'll have a breakup for it, why we are putting it in 5O, which also the government allows. That is the way in which it has to be reported as per the instruction. Alternate method could be report the total turnover there and reduce the adjustments on account of cost, because the P&L has only the profit. So to the extent of cost, if you do the adjustment, cost of purchase of asset 1 crore, if we going to reduce that, naturally, sorry, if you're going to add up that, naturally it will match with the GSTR9 annual return. 2 ways of reporting it. I would recommend the first way. I would recommend it to be reported in 9, and then it should be reconciled with 9C. But again, alternate models are there. Somebody would say, no, that is not fair. This is not my main turnover. That is not my main income. That's an extraordinary income. XYZ reasons are there. So to bring it as a net number, end of the day, somewhere it has to be reported. It cannot be reported as a difference in turnover. Let me repeat. This is one challenge we are facing. No, very simple. I will report my total turnover. And if I compare with the annual return, there will be difference of 2 crores. If somebody sees my balance sheet, 2 crores is profit on sale of land. Matches? No, agree. I'll give reason. I'll give reason in my reasoning sheet, which is there in the next table. I'll give a reason in my reasoning sheet. Reason of 2 crore difference is on account of sale of property. Why it is fair only? No, correct. But with limited information, many times the scrutiny is picked up. Many times a preventive officer picks up the case. Many times a GST departmental audit is stepped into the office is on account of improper filing of 9C. Improper filing of Form GSTR9. These are the reasons. There have been many cases. It has been witnessed on account of this. So in my humble view, table number 5, table number 6, normally, in a normal circumstance, should not have differences. Now, where did I put all those differences? 5O. Law says wherever if you find something is not fitting into it, then put it in 5O. Have a information associated with it. When 9C is there, already we have 2 additional attachments to upload, apart from the other uploads which are mandatorily to be done in connection with balance sheet and financial statement that can be added. In case somebody omits to report the exempted turnover to the extent of exempt in annual return, they fail to omit the interest income. Interest income, why should I report? Exempted income. Notification 12 of 2020, notification 12 of 2017 in its entry very precisely says interest on account of deposit loan advances is exempted from levy of GST. If a fixed deposit is made for obtaining some bank guarantee, on the fixed deposit, there is going to be an interest. That interest is forming part of the other income, and that other income is naturally forming part of the financial statement. Then that interest income should be reported in exempted supply. So in table number 5, that interest income to be reported, else naturally will form part of difference. In my view, don't report it as different. At least in 5O, mention that amount and have it. As I told, this is my independent thought process. The table number 5 and table number 7 should not have differences is an ideal way of reporting the annual return along with reconciliation statement. In case if there is differences, the differences could be on account of exempted supply, non-reporting of an exempted supply, or non-reporting of a non-GST supply could be the differences. That is the first differences, because this information is compared there in table 5N. 5N of GSTR9 is cross-verified here, is cross-reported here. If you go back to 5N also, you would have referred table 9C 5Q, which means this is the comparisons of the data. Followed by, no, we have reported every exempted turnover. In spite of that, there is differences, means maybe a taxable turnover not reported. This alone can be a reason. Either an exempted turnover not reported, or a taxable turnover not reported, or a non-GST turnover is not reported. That is the reason for a difference between annual return and reconciliation statement. Beyond this, expecting any other differences is certainly not possible. Having consolidated the turnover compared with the gross turnover, we are now more bothered about always a taxable supply. We are not bothered about the total aggregate turnover. From the aggregate turnover, now we will be excluding all those exempted supplies, export of goods, export of services without payment of tax, supplies to SEZ without payment of tax will get reduced. All these numbers are already available in table 5A and 5B of GSTR9. That will get reflected here and get reduced. Followed by 5D, 5E, 5F, discuss about nil rated turnover, exempted turnover, non-GST supply. That is also reduced. So I'll come and land in my taxable supply. So taxable supply as per 9C and taxable turnover as per 9 shall match. At any point in time shall match. If it does not match, it means assessee thought it is an earlier exempted supply. Now he is going to agree and pay that it is a taxable supply. If he agrees and pay, let him report it in table 9. Why he has to report in 9C as a difference and invite somebody's attention? Let him report in table 9 itself. If yes, I thought it is an exempted supply and that 1 lakh rupee will not come. Later on, my respective statutory auditor, later on, my GST consultant says, no. You go and read through the place of supply. The place of supply is location of supplier. This is an intermediary commission. This is not an export of service. So it will not form part of your export of service without payment of tax. It will now form part of your B2C turnover under CGST, SGST. Let me report it under B2C, pay taxes. At last, my turnover will match. Let at least the turnover matches so that I will not have anything to report over here in table number 8 is one of my submissions in connection with. When it comes to turnover, to the extent possible, it has to be reconciled and reported accordingly. GSTR 9C, table 9 requires for the first time a classification of the turnover at rate wise. There also a rate wise classification need to be done 5, 12, 18, 28. Each tax along with RCs. Reverse charge tax how much? 5% RC how much? 12% RC how much? 18% RC how much? 28% reverse charge how much? 28% reverse charge and all rare. Predominantly 5 and 18, rarely 12, very rarely 12, but predominantly 5 and 18 is the common entries when it comes to reverse charge. Forward charge, all rates will be applicable. Furthermore, special rates are also there. Now here, disadvantage of the table, not the rate-wise state of tax. This table does not have a total. One of the common problems is there is no mechanism to add my values. Let me repeat it. If I give a breakup of reverse charge 5% and 18%, so much I have paid, my turnover should naturally match with table GSTR9, table 4G. In 4G, if I reported 3 lakh rupees and for value for which RCM I have paid, 1 lakh is for 5%, 2 lakhs is for 18%. Then here also, if I add, I should get 3 lakhs. There are cases at times we come across, there are cases which are all taken for scrutiny. Because here it is not matching, there will be duplication, there will be addition. I agree. This is only mathematical. Do agree, this cannot be. But why an invitation comes from an officer? When you get into that reason and logic behind it, these are all the reasons. A turnover independent reconciliation need to be done, ensuring that whether all these turnover, because the interest of the government in table 9 is not to match the turnover. The interest of the government in table number 9 of 9C is whether the tax already paid by you and the tax now you are mentioning here, no, that you pay rate wise, is it matching? And again, there are cases where this is not an auto populated data. Let me repeat, it's all keyed data. There are cases where turnover is reported in 5%, but the rate of tax or the tax amount when we see it is 18% paid. That's okay. I do agree. But here the requirement is rate wise reporting need to be done, which need to be taken care. And let me repeat it. Table number 9. Certainly you will have difference, except you have not paid 1 rupee late fee or 1 rupee interest. Except for an assessee who has not paid even 1 rupee as interest or 1 rupee as late fee, except that individual taxpayer, every fine we will get difference in table number 9. Table number 9, if we get difference 9 of 9C, if we get difference, it's quite natural, forget it, because there is a problem in the formula. When they need to, when I report here interest, when I report here late fee, when I report here penalty that I paid during the year, my cross reference in the table number 9 of GSTR 9, when they pick up the cross reference, they are picking up only CGST, SGST, IGST tax bill. They are not picking up my interest. They are not picking up my penalty. They are not picking up my late fee. Then naturally, I will have a unreconciled number for which an explanation need to be given in table number 10. If you have difference in table number 9, it is natural. It's natural. Let me repeat. Or else, no, I don't want difference in table number 9. Then you should not report your interest and late fee or penalty as the case may be. No, I want to be very fair and report it because I have paid. Then definitely you will have a difference in table number 9, which need to be reconciled. This here you will get the difference and it has to be reported is the thought process associated over here in 9C. Getting into any additional liability if they want to discharge through 9C. Usually it will not happen, but sometimes no, assessee has erroneously filed 9. There would be at times a few people in certain organization, they would prefer to file it, but halfway through, after filling 9, they will come across and say, no, this decision we would have not taken. It is pinching us because it was a wrong decision made by us. We have reported erroneously. There are cases where things like this. In those circumstances, yes, there would be a possibility of additional tax liability payable. Input tax credit, part 4 of the 9C would discuss about input tax credit, where this time government made a point very clear. What is your gross ITC as per the books of accounts, and of this ITC booked in earlier year, claimed in current year, how much? ITC booked in current year, claimed in subsequent year, how much? Booked in current year, claimed in subsequent year is the data already available in table number 13. So that data can be captured and maintained. ITC of last year claimed in subsequent year is also already a data available because last year they would have reported, which is a mandatory data that will come. Why? Because this 2 data earlier government said it is optional, you don't fill, you simply put what is your gross ITC in table number 12A and that should match with your 9, we will exclude it. But here there's a problem. Generally, I'm talking of general situation. Generally, it is easy for an organization to accumulate a data of gross ITC for the year rather than a net ITC. Because if there is a table extract available to me, from a ledger extract available to me, if I sum up all my debits, I would land up at a gross ITC under that particular rate of tax or under that particular ledger head or for that particular GST, and as the case may be. But of that, a few credit I would have reversed. Not every credit that I reverse will pass through my credit ledgers. It will pass through some expenses ledger. So it is easy always for an organization to take a gross credit. So if we feed a gross credit, let me repeat, gross credit from books of accounts, that is in other words, there is a ledger. The debit side is, I have took a CGST ledger and the CGST ledger says 23 lakhs. Then I would feed the 23 lakhs over here. But I've also taken CGST 23 lakhs, SGST 23 lakhs. Of the 23 lakhs, as per Rule 4243, I reversed 3 lakhs. My net ITC is 20 lakhs. Net ITC is what getting compared here. What comes from GSTR9 is not table number 6 entry. Table number 6 is about gross ITC. What comes here is net ITC. So certainly table number 12, we will have differences on account of ITC reversed during this year or this year ITC reversed in subsequent financial year or any other ITC paid through DRC 03. So a reversal of ITC certainly possible in connection with, or the difference on account of reversal of ITC is certainly possible in table 12. If somebody feels, no, I don't want this, then at the gross entry level, that is 12A data should not be a gross ITC from books of account. It should be a net ITC from books of account. Extracting net ITC from books of account is little laborious activity as compared to gross ITC. Let me repeat. Gross ITC is easier for everybody because all that I need to go to a ledger, extract an information and feed it down, I'll get it that number. Or I have a inward supply register independently maintained. From there, I give a summation formula, I'll get that number. Getting gross is easy. But where all my that month, then all that adjustments need to be brought down somewhere. If they have a strict accounting modules, then yes, they can come up with that proposal of net ITC as per books of account. If they feed in net ITC, then there will not be difference. But if they feed in gross ITC, certainly there will be a difference. That difference need to be explained in the below table reasons for that. Table 14, expenses wise information, that too little, they are little careful here. Value, total ITC, amount of eligible ITC. Let me repeat, that is close to impossible. But that is why government till today said it is an optional table, table 14. If you want, you fill. If you don't fill, you don't fill. But it's better to fill it because at audits, at scrutiny, at inspection, everybody want information. Everybody come out and say, why can't you fill table 14 and give it to us? And for this activity, which any case at a later point in time where we have to break the head and do, at the time of filing annual return can be better done and submitted over here, where up to 5 different other expenses is possible other than what is the basic breakup that is being given in connection with a few expenses of purchases, freight, power, fuel, or rent related expenses, bank charges, employee cost, entertainment expenses. Under any other expenses category, a few categories allowed. It's preferred. If you ask me, it's preferred to give a breakup of these expenses because a better disclosure by the assessee would protect the assessee in case if there are few credits which are all little litigious in nature. There can be a credit where assessee would be, and no doubt is entitled to credit, but it is subject to various litigations associated over there. let's say for a purpose of a discussion, because during COVID times we had a MOH guidelines which said it is a responsibility of the employer to pick up the employee and drop the employee. There were organizations who used cabs based on the guidelines. There are organizations who sent a 6 people cab where only actually 3 people were carried to office or 4 people were carried to office. In this backdrop, my point to press upon is, in a normal circumstance, this cap credits would be denied. But on an exceptional circumstance, like where the COVID is present and where a strict guideline is all there, this credit would be entitled for claim of ITC. So those impacts, where if we have a category of expenses or a schedule gets uploaded saying that a few cabs expenses breakup is available, something to do with transportation related charges or cab rentals, wordings like this are present and it is there. To that extent, suppression can be protected. A larger invocation of time by the officer may not be warranted. We can always very well say, as part of my compliances, annual compliances, I have uploaded enough information. When so much information is available with the government, you cannot extend the time limit as per section 74 for a period of 5 years. So those are the insightful points in connection with why somebody has to report table number 14. But of course, no doubt, as it stands today, it is just an optional entry. Entire number can be reported under any other expenses, and no authority would question or deny the filing of annual reconciliation statement on the ground that it is erroneous, that because table 14 is not properly filled, because already option is on in connection with this. Here also, as I earlier said, reporting with net ITC. I know I have reversed at least, let me repeat, at least at table number 12 level, I have taken a total credit of 4 crores. Of that 4 crores, 20 lakhs I reverse. My net ITC is 3 crore 8 lakhs. To that extent, at least I can get data. Because I may add all my summations, because all these are all routed through a particular just ITC reversed during the year to that ledger. If I go to that ledger, if I sum up, I'll get the 20 lakhs. I can reduce and save. Of this ITC reversed, how much is on purchases, how much is on bank charges, how much is, certainly not possible. In fact, for that reason only, majority of the organization don't give. But my humble submission is, we can give the gross number and say 20 lakhs is reversed during the year on account of reversal. What I'll give a breakup for 4 crores. Whereas my net ITC will say only 3.8 crores. I'll have a difference of 20 lakhs. What is the difference of 20 lakhs? 20 lakhs is on account of reversal tax. So these are the requirements in connection with the table 14 and associated reasoning in 16. In case of any ITC which need to be reversed further, then that would be reported in table number 16, and a summation of table number 11 and table number 16 in terms of output tax liability, any differences, or ITC related any differences, then it would be consolidated at reconciliation statement and then it will be paid to the government. This is a broad discussion in connection with compilation of GSTR 9 and 9C. There are a few questions on the chat box. Quickly, I'll take it up some of these questions subject to.
Yes, sir. The questions in Q&A panel actually.
Yes, sir. I'm just pushing 1 minute. In the case of securities, share commission agent, apart from the commission income, if the taxpayer is also engaged in sale of securities, which has been treated as a business income for the purpose of income tax, the volume of the commission income and the security sales exceeds the threshold limit, applicability of 9 and 9C. The securities transaction being not a supply, whether aggregate for whether the aggregate turnover to be considered. This question is raised by Sharada S. Kamath. My answer to it is, you consider only the commission income for the purpose of aggregate turnover, but please don't consider the sale of securities, because sale of securities cannot be considered as a as a turnover for the purpose of GST, because when you go back to aggregate turnover would be defined in a particular way. It includes taxable supply, exempted supply, zero rated supply, and non-taxable supply. And no doubt, non-taxable supply means supply of goods or services which is not leviable to tax. Securities is outside from the tax. Securities is neither a goods nor a service. So first of all, something should be a goods or services. So in my view, the share income need not be, the sale of shares should not be considered for the purpose of computing 9 and 9C, but on a abundant, precautious, conscious note. For a few organizations, we take a little conservative stand, because those are all larger organizations where in case tomorrow, if there is a non-compliance, it is looked a little seriously because of the type of those organizations. We have a little different model which is being done. What to do for a double entry of an invoice in GSTR1? If you are sure it is a double entry, then and it has been paid only once, maybe at a 9 level you can report that only once, and you don't need to pay it for one more time. Where should we report? Salim Padmini has raised this question. Where should we report high C sales made by a merchant exporter who is doing export under LUT as well as high C sales? Good. High C sales is nothing but a sale that happens before crossing the custom frontiers of India. On account of that reason, this is to be reported as part of non-taxable or a non-GST supply related turnover. There it has to be reported. In which table should we declare ITC pertaining to a previous year but claimed in current year? There is no table for that. This question is raised by somebody who's not shared the name, but nice question. Point here is there are no tables. Technically, that is why you will have a difference in table number 8D, which you have to internally get confirmed in connection with it. ITC reclaim for reversal made under 37, if it is shown in 6H, then there will be a difference in table 8D. What has to be done in this case? Let me repeat. At the gross level, Selva, I'm getting an echo. Why?
We'll check, sir.
Okay. Now coming back here, this question is raised by Kiran. 6H number is a number which is reversed and reclaimed. Let me repeat. 1 lakh is my turnover. Oh, sorry, 1 lakh is my ITC. In 6B, it would be reported. And during the year, 10,000 rupees was reversed. So naturally, it will get reduced in the table number 7, 10,000 rupees. It was reclaimed during the year itself. Then again, it will be added back. So only then we will have this. Otherwise, there will not be a difference associated with it. More preferably, this would be warranting if there is a timing difference of in the previous year, I have reversed under Rule 37, and in the current year, I reclaimed it, then it would be of more use. In the same period, in my view, it does not make any much differences of it. If there is a timing difference on account of previous year and subsequent year, then reporting under 6H would be ideal and proper for that. ITC reversal made in subsequent year 3B is required to be shown in table number 7 or table number 12. In my view, it has to be shown in both the table, because table number 12 is the information. Table number 7 is we have to reduce that ITC because it is a reversal of this year. The challenge is if tomorrow an officer says you have to reverse so much for 42, 43, you are not reversed, I'll proceed against you, then how are we going to defend ourselves? So is it not my next year reversals will be more? Do agree? This is one challenging situation where this independent calls has to be taken based on case-to-case basis. There are no generic answers in connection with those aspects. in table 8B, whether to show gross ITC or net ITC. Again, Kiran has raised this question. See, 8B data entry is not allowed. 8B data will be automatically auto-populated from 6B and 6H. That is ITC taken by the registered person, followed by ITC is as per the ITC taken by the registered person on B2B supply, then ITC reclaimed. Both turnover will be added and automatically come in 8B. I don't think so 8B can be allowed for amendment. Only 8C is allowed for amendment, or 8C is allowed for reporting the numbers of this year ITC taken in subsequent financial year. So naturally it is a gross number. What is reported is a net number. You have also, see, as long as it is only that year credit note is there, then no issues. If in case it is a previous year credit note, or some of the organization has the practice of, in case of credit note, they go to reversals and others and they put the reversal. There are different practices followed by assessees. What is the practice of the assessee will decide the method of reporting associated with it. Tax paid through DRC 03 to be reported in table 14. Yes, if in case it is relating to a turnover reported for subsequent financial year, yes, it has to be done. Whether HSN code need to be given for both taxable and exempted supply for goods in the form of GSTR 9. Yes, HSN summary wise information need to be given if it is turnover more than 5 crore, then 6-digit level for all B2B supply. And if in case it is going to be a B2C supply, then it is not mandated as per the law as of stands. Whether it is mandatory to complete table A reconciliation in case of large manufacturing entities, there will be multiple reasons for non-reconciliation, and still we'll continue to upload PDF in GSTR 9C. In my view, uploading PDF is a better option, because do agree in case of multiple bigger organizations with multiple units, it's always better to upload the reconciliation done by the organization, because I still could able to think of a lot of situations. Previous year credit note reported by my suppliers during current year, previous year ITC reported by my supplier during current year, where ITC is taken by the assessee in previous year in some cases, ITC of those reporting taken by the assessee in subsequent financial year, but entry passed in the books of account earlier year. Unimaginable reconciliation it will go. People have to break their head in deciding the answers for it. But again, points for our discussion is better is to report what is the actual reconciliation for 8D there. Sale of land, sale of share, which are capital asset, non-farming part of the books, whether to show in non-GST supply. If it is for an individual, then may not be warranted. If it is a company, then think about it. Maybe if it is an individual, you can always say it is it's part of the individual account. If it is a corporate, I don't think so that answers can be given. Please summarize once more table 4, 5 and disclosures under table 10 and 11. Very simple. That year transaction reported in that year, then table 4 it will come if it is a taxable turnover. Table 5 it will come if it is a exempted turnover. That year transaction got reported in subsequent financial year, then it will come in table 10 and 11. Table 10 for additionally reporting revenue. Table 11 for any credit note of this year reported in next year. That's the summation. Sum and substance is, that's all in connection with this. GST audit by a CA limit for financial year 2022. There is no GST audit as it stands today. Section 35 got amended. It is only a reconciliation statement or a reconciliation statement or annual return to be filed by the assessor. Is financials of a branch office having separate GST number need to be certified by an auditor? I don't foresee that it is mandated, as long as the Final financial statement is an audited financial statement that would be sufficient. I have a RCM liability for financial year 2021, which is noticed in the month of October 2022. Can I file DRC03 and claim credit before 30th November? Yes, very well. 2021-22 liability can be paid. RCM to be credit taken before filing of October return by 20th October, or if you have holded your October return and you're going to file it before 30th November, very well possible. After that date, I don't think so it is possible. If separate annual accounts is not available for branch wise different GSTN, what are the attachments we have? See, when wherever separate annual accounts are not available, we will do every reconciliation for the consolidated. See, with due respect, there are organizations where we have come across, they do a multi-crore turnover, they come out and say, we don't have a, what is it? A state-wise P&L and profit and loss account and balance sheet cannot be given. Or at least we can give you P&L, but balance sheet and all is not possible at state-wise. It is possible that every time we have to reconcile it only with a consolidated number, if in case a state-wise is not available. Where to disclose dividend income? Yes, it is a non-GST supply under that heading. If it is there, it needs to be disclosed. Do we need to provide ITC breakup in 9? Prima facie ITC breakup per se, we are not obtained. We have to just categorize the entry either as input or input services or capital. To that extent only it is getting reported in connection with answer. Petrol station, whether RCM will apply on inward freight charges. Is the petrol bunk is paying transportation charges? I am given to understand either the petrol pump will have their own lorry or the respective fueling station will pay the charges under RCM. So in case if there is an exceptional situation, if the petrol pump pays for the petrol freight charges, I am of a view RCM would be definitely applicable, and the respective organization has to discharge their tax liability under reverse. No, two views is not the practice that has been followed in many cases. This to the extent what I have seen. Does turnover include only turnover income shown under the business or profession, or should it also include other income such as salary, income from other sources, and capital gain? It's a little tricky question. In my view, I am of a very little conservative positioning that even if a person has an interest income, the moment he is registered, even if he has an interest income, a salary income, then interest income should form part of exempted supply, salary income should form part of non-GST supply. If he has a capital gains on account of shares, then it should form part of the non-GST supply. It's required because I do agree, one can always defend, no, this is done on account of personal nature, that is done on account of official capacity or on a business capacity. But it is very tough to prove some of these requirements. That is the difference that we are trying to draw over here. ITC debit note for purchase return, whether to show in 6B, ITC debit note for purchase return. For a purchase return, Kiran, it is the supplier would have given credit note. For the supplier would have given credit note, you would have adjusted your ITC and would have availed only that credit. So what was the method of reporting of assessee is more important. I am of a view, 1 lakh rupees worth of ITC, you have procured goods and you have returned 10,000 worth of ITC goods means you should report only 90,000. If you have reported 90,000, then 6B will say only 90,000. No. I have taken full credit of 1 lakh and I have reversed in the subsequent month 10,000 rupees in my GSTR 3B in table 4B. Then table number 7 will have a reporting of 10,000 because their reversal is automatically there. Means how you report, what is the practice of the organization, that plays a very key role. But a better way of presenting would be taking the net ITC is a better way of presenting, is what we understand. In case of non-GST supply, whether we have to give a HSN summary. If it is a non-GST supply, I don't think so HSN summary is required, because HSN summary is, as of today, it is only restricted to all those B2B supplies. The moment if it is not a B2B supply, then I don't think so the reasoning would be required. If RCM for the financial year is reported in financial year 2022-23, how do we need to report in 9? A nice question. If it is reported in 22-23, 4G should contain the turnover details. Table 10 should contain the tax details. Table 14 should contain the tax details and its payment details. So little tough reporting. 4G turnover, table 10 tax details, table 14 tax details. Okay. So that is how one way of reporting. Second simple way of reporting, report it in next financial year, because government through its press release told report it in subsequent financial year. That is how they have told in connection with it. Followed by last question. Table 12 and 13 of 9, 8C equal to 13. Let me repeat it. 8C is not equal to 13. A nice question, Prabhu Mary. Table 8C is not equal to 13. See, table 13 is all about this year ITC taken in next year. This year ITC taken in next year can be on imports, can be on B2B supply, can be on RCM. So 13 can be a larger number, but 8C will be a smaller number, because 8C is restricted only to B2B supply. I would have received a bill of entry this month end, March 2022, let's say. But I would have received the goods only on 10th of April 2022. Then actually I will take credit only on 10th of April, which means where I will report that? I will report it only in table number 13. It will not form part of 8C. I have a RCM and it's my practice. Let me repeat. I know still a lot of organization. This month I will pay, next month I will claim credit. Why to be bothered about, or why to be with the mercy of government? Let me follow what I have practiced in service tax rates. But prima facie, I don't agree to that view. Okay. But there are views that this month I'll pay, next month I'll claim credit. March month I'll pay. Naturally, April month I'll take credit. So if this be the cases, then 8C is not equal to 13 is a simple answer. Okay. So followed by whether reporting of HSN, SAC details on inward supply is also compulsory. No, reporting of inward supply is not compulsory. As of now, outward supply, that to B2B supplies alone, it became mandatory. Can we upload instead of branch-wise financial statement, the consolidated statement and do a reconciliation for that? Yes, definitely we can do. Why not? It can be done. If RCM for financial year, is there any other questions, Selva, somewhere?
No, sir. Only thing that is in questions
Now coming in. Okay. Okay.
maybe.
Okay. If RCM for the financial year 21-22 is reported in 22-23, how to report it in 9? Yeah. If 21-22 you want to report in 22, if RCM of 21-22 is reported in 22-23. Okay. 21-22 is reported in 2023, then straight away report it under 4G. Straight away report it under 4G and leave it as it is. Nothing. Don't do anything. It was actually a last year liability, but you have paid it only now. Report it under 4G. Table number 9, form GSTR 9, table number 4, row G. You report it under 4G and leave it as it is. Because I'm not very sure last year what you did. Technically, what you should have done, this is a little technical point. Last year, 4G, you should have put the turnover. And last year, table number 10, you should have reported that. Apart from the outward supply, a tax amount for reverse charge and in 14 you should have report. That is how it should be done. Now, because that if that was not done, simply report it in 4G. That would be the simplest answer. Petrol and diesel is non-GST supply. Petrol and diesel, will it come under aggregate turnover? Yes, very much. It is a non-GST supply, so it will come under GST turnover. Every petrol bunk will be covered under 9 and 9C compliances. So, ITC on GIT as on 31/3/2020. Oh, goods in transit. Okay. Is shown in table 13. Then there will be a difference in 8D as there is included in 8D. Kiran sir, definitely there will be differences. Okay. You should start having reconciliation for the reason for differences. That would be my simplest submission. If everything is tally, then maybe that can happen in the subsequent years to come. But prima facie, as of now, it is not possible. Branch-wise financial or consolidated financials for uploading GST or 9C for each branch-wise. Sir, if you have a branch-wise financials, please upload a branch-wise financial, reconcile everything with branch-wise financials and conclude it. If you have only a consolidated annual financials, then please consolidate, do every comparison only for the consolidated financial and conclude it. Okay. So that is how it has to be done. Yes, sir.
We're done with questions. That's it.
The questions all done.
Yes, sir. Thank you, sir.
Thank you all.
That's about you, sir.
Listening. And I thank the organizers and the technical team for the support, and in the the vice chairman, secretary, treasurer in absentia for giving us the opportunity to share the thoughts. Thank you all for it.
Sir, I am there, sir. Vice chairman is there. I'm Pandaraj.
Sir, sorry, sir.
Yes, sir.
It was a very interesting, this one, despite the visit of some of my clients, I did not stop it. And thank you very much on behalf of SIRC, on behalf of whole managing committee of SIRC. I, Pandaraj, Vice Chairman, thank you very much from the bottom of my heart, sir. You are the real assets of the institute. By seeing the number of people that are done, more than 250 throughout are there. And also I thank very much each one of you members, but for your participation, these programs will not be there. You can just imagine being so busy. Ganesh Prabhu sir has taken out two hours plus to attend and clarify the things here. And it was so lucid presentation. Whole of my office is watching this. And even the students are so eager to listen to you. So that should be really very worthy. And for your information, thank you for your participation, and for your information, this will be uploaded in due course of time on YouTube also. If you have any doubts, please feel free to mail Prabhu sir, because he has already given his mail ID there. And I thank all of you once again for your participation, and I thank my chairman and secretary for giving me the job of comparing this program as well as learning process of this 9 and 9C on this day. I also thank the office bearers, office back office and technical staff led by Mr. Selva. Once again, thank you very much, sir.
Thank you, sir. Thank you.
Thank you, sir. Thank you.
Thank you.
Thank you all. Good night.